Now, a resurgence of European debt concerns adding yet another layer of uncertainty to the markets. My next guest says that if you obsess over data and headlines, it just might not help you make any money. Instead, you should think hard about what's a good investment and what you should actually pay for it. I want to welcome Michael Harkins, partner at Levy Harkins. Michael, good to have you with us on Taking Stock.
Thank you very much, Pimm.
So we should just forget, at least when we're making our investment decisions, put the big macro data headlines aside, at least for a little bit when we're trying to figure out what to do with our money.
Yeah. The biggest economic event of my lifetime, most of our lifetimes, is the recession that started in the third quarter of 2008. Okay. The data was released, the GDP data was released on 8:30 in the morning on October 31st. If you recall, the stock market was crashing. Stocks were just being annihilated. And the GDP data came out, and it said that third quarter GDP was down 0.3%, which was a mild, nothing,
right,
what was there to be worried about number. Yes. Now, if you're not a full-time consumer of these economic numbers, you don't know that they get revised all the time. The most current revision, and it goes on for 3 years, by the way, the most current revision is that, in fact, in the third quarter of 2008, the economy contracted by 4%. It was 12 times, 13 times worse than they initially told you. Now, I'm not alleging that the people at BEA who compile these statistics don't know what they're doing, and I'm not alleging some sort of conspiracy. I'm simply saying that the best minds in the business get this horrifically wrong, and they tend to make great revision errors right at the moment when the data matter the most. So if you'd had, we'll do a little thought experiment here for a second. Suppose you'd had these data a week ahead of time, and some stock market deity told you you won't get caught. You can insider trade on these. Well, you wouldn't have gotten caught, but you would have gotten killed, because you would have insisted on buying many more shares, maybe even going on margin, and you could have really done yourself some damage. So don't even wish that you had. You know, Warren Buffett has a partner, Charlie Munger.
That's right. Wesco Financial.
Wesco Financial. He is a lawyer out in Los Angeles. We have friends in common. And I'm told that Charlie gets up at 6:30 in the morning, which means every 8:30 in the morning number ever released, Charlie sleeps through. That's the most reasonable way to deal with him.
So the idea is maybe put some of this noise aside when actually looking at ways to make money.
Right. It matters so much more whether you're paying the right price for a stock and a bond, and not so much whether this quarter is going to be good or bad or indifferent. I mean, if you can get the nature of the business right, that it actually produces cash to you, and you can say something confident about what price you should pay for that, the cash that will come to you will be way more than you could get if you owned a 10-year Treasury note over the same length of time. Worry about that and whether the management knows what it's doing. Those are all things, those three things you can actually tell every day.
You're sounding almost rational, Michael Harkins. I mean, is that something that you can fit together, that you can integrate with the daily storm of information that most people seem to have to contend with?
Sure you can. And the fact that I know that my economic opinion isn't worth anything gives me a tremendous edge over everybody else who thinks their opinion is worth a lot. Because I spend my days focusing on what's knowable and don't give much thought to what's unknowable, even by the great minds at the BEA, the people who make the statistics.
Well, it's almost this idea that, you let the big things take care of itself, but you can only focus on the little things that you actually know about and that you can get your mind around. Is there a particular example? I mean, I know in the past you talked about Tupperware as a company that you've been following. Is that an example of the kind of thing you actually know the business that they're in, you know the people that are in the business, and you know the price that you can pay for it? It's there, it's available to you every day on the close.
Here's a remarkable thing. Since so many people pay attention to so much else, when you look at businesses and you say, does this company actually return cash to me that I could go spend on something completely different? Just knock a whole bunch of zeros off the income statement, and let's say Pimm and Michael own it together. Now, can I go spend that money on something else? 3/4 of the companies in the Value Line survey, you'll discover you either put back all their earnings and then some every year into the business, or 3 years from now you won't have an asset to come back to. Okay, here's one of the secrets to investing. Don't buy those businesses.
Throw all those away. You don't have to actually look at those. It makes it easier to actually find the businesses you want to own.
If that's 3/4 of the stock exchange, and it is, and now here's the next most amazing thing. They don't charge you anymore in terms of PE ratios. They don't charge you any more for good businesses than for bad businesses. Why is that? Because Wall Street always loves the bad businesses. They're the businesses that need money. They're the businesses that need financing and bond offerings and new products.
And then they get coverage on Wall Street, and then that ends up creating this marketing machine which sells the shares of those companies to investors.
Absolutely right. And Tupperware will never be back to Wall Street for money, because I've joked with the CEO, Rick Goings, first time I ever see a receivable on his balance sheet, I sell. There never are any. He doesn't have the need for that. I know when I speak at Tupperware, it always produces a smile on people's face, but it's a remarkable way to make money.
And it's not just in the United States. I know that that's also been a focus of yours, is to try to combine a theme with the strategy of the company and then see if they're really executing.
Well, because 85% of the revenues come from outside of the United States. I love it for that reason, because I am so very worried about quantitative easing. It's a brilliant expression, but it sounds just like printing money to me, or rather it looks just like that. And I worry about inflation, and this is a natural inflation hedge.
What are we going to see that will give you those signs that inflation is going to take off? Because you take a look at the 10-year, the 30-year Treasury bonds right now, that doesn't seem to indicate there's any inflation.
Markets are inefficient, and I think the efficient market hypothesis has an awful lot to answer for here. 3 years after this crash began, nobody would have packaged mortgages and bought them with such promiscuity the way they did if they thought they were actually going to be held to account. They thought the markets are endlessly efficient, therefore I don't need to go read those boring documents. That really has been a pernicious idea that has infected all of Wall Street. So I think somebody getting 2.5% for a 10-year Treasury, he's just risking his money, and he doesn't understand the degree of risk. Also, I think municipal bonds, these people don't understand there's both the risk of default and there's the risk of inflation, and they're both very real.
And we always love having you around to help us understand these risks. Michael Harkins coming to us from Levy Harkins. Appreciate your insight.